Welcome to Mayor Brown's Tech Talks podcast. Each podcast is designed to provide insights on legal issues relating to technology transactions and keep you up to date on the latest trends in data, digital, outsourcing, and software by drawing on the perspectives of practitioners who have executed technology transactions around the world. You can subscribe to this series on all major podcasting platforms. We hope you enjoy the program.
Welcome to Tech Talks. Our topic today is insurance technology and innovation, meeting consumer demands. We'll talk about how technology and innovation are empowering insurance operations, influencing regulations, and changing the ways consumers think about insurance. I'm your host, Julian Dibbell. I am a senior associate in Mayor Brown's technology transactions practice. Joining me today are Mayor Brown partners Rohith George, Paul Chen, Yevgeniy Markov, and Senior Associate Yuliya Feldman. Rohith is a partner in our technology transactions practice in Mayor Brown's Palo Alto and San Francisco offices. He focuses on helping companies navigate complex commercial arrangements involving mission-critical technologies. Paul is a partner in our corporate and securities practice in Mayor Brown's Silicon Valley and San Francisco offices. Paul advises clients on mergers and acquisitions, early to late stage investments, alliances, and other corporate transactions with a focus on the insurance industry. Yev is in our corporate and securities practice in Mayor Brown's New York office. He advises clients on a variety of insurance, corporate, regulatory, and compliance matters. Yuliya is a senior associate in our corporate and securities practice in Mayor Brown's New York office also, and a member of our global insurance industry group. She advises U.S. domestic and international insurers, reinsurers, and other insurance intermediaries. So welcome, everybody. I'd like to start the discussion by laying some groundwork here, particularly for those who are listening whose only experience with the insurance industry may be wrangling with insurance adjusters or paying monthly bills. Paul, for those of us in that boat, can you tell us a little bit about how insurance has been marketed and sold historically?
Julian, the insurance industry has certainly evolved over the years, and partly through technology, is trying to shake off this image of customers dealing with cantankerous insurance adjusters or going through a cumbersome underwriting process to buy insurance that they don't necessarily think they need. Historically, the insurance industry, which has been around a long time, has kept much of its data in paper form and conducted many of its business processes manually, meaning that human beings had to make decisions along every step of the way with data that could not necessarily be pulled up at the touch of a button. For example, in the not so distant past, an insurance policy could not be issued to a customer without a live agent brokering the underwriting process with a prospective customer. An insurance agent had to collect data about the customer, coordinate with a live underwriter to determine eligibility and pricing for a policy. And the documentation process was generally time-consuming and unpleasant, as many of you probably have gone through. Although later to the game than other consumer-facing businesses, the insurance industry has been heavily investing in technology and innovation, driven largely by the need to create a more dynamic consumer experience for insurance customers. This process of implementing technology and innovation to the insurance business is the heart of what is commonly referred to today as Insurtech. Yes, the challenge of Insurtech is making insurance exciting to consumers.
Okay, and how exactly is that changing things?
Yeah, consumer processes have generally changed. They do not want to go through a cumbersome process anymore in buying an insurance product, which they don't fully understand and don't think they necessarily need. In the era of comparison shopping by computer or mobile phone, consumers don't want to be pushed into a product. They want to make product decisions from their own research, or at least based on what they hear others are doing from social media. The insurance industry's legacy of manual data collection and somewhat bureaucratic operating processes have continued to some extent to this day. Although most players in the insurance industry have large IT systems to store data, the industry is still at the early stage of finding ways to analyze and use information to target healthier, less accident-prone consumers to develop more tailored products. So Insurtech is focused on digital interfaces and social platforms to reach out to customers, to educate people about insurance and enable them to quickly buy simple insurance products. Although live agents are still part of the sales process, they're increasingly involved only at the point of sale, rather than pushing an insurance product to an individual customer during a lengthy information gathering and negotiation process. Although insurance regulations can limit the extent insurance companies can collect and use customer data, which we'll learn a little bit later, we are seeing that the insurance industry is using social media and mobile applications to identify and attract customers. We are seeing the insurance industry using sophisticated data analytics and artificial intelligence and machine learning to assess the potential risk of an individual customer and to determine the appropriate pricing of a policy for that customer. And finally, we are seeing consumer-friendly mobile applications and data verification systems to help policyholders make claims and receive compensation for losses much, much faster than ever before, with much less paperwork and less fraud. Rohith, what do you think?
Yeah, I mean, I agree with everything you just said. I think there's the customer acquisition and retention side of it, and then there's the underwriting, pricing, operations side of it. As we make advancements in technology, in machine learning, in robotic process automation, data aggregation, analytics, I think it was always a given that the insurance industry, just like any industry, would be motivated to kind of make use of those tools to reduce their costs, to minimize losses, so on. But you add on top of that the fact that the way that consumers purchase and consume products and services has changed, not just in how they shop for clothes or watch movies, but also in how they invest their money, how they apply for loans, and importantly here, how they buy insurance. It's becoming less and less about finding a trusted advisor and more about, as you said, whether the product fits your lifestyle, whether it's convenient to buy it. I think that's an ongoing change, and the impact that it has on how insurance companies acquire and retain customers. It's really been a huge motivating factor for some of the innovative things that we're seeing in the market.
And new technologies, I think, also are being involved. Can you give some examples of how insurance companies are reaching out to consumers through, not just social media, but new other new technologies out there?
Yeah, I could give one in the life insurance context. So Insurtechs or early stage companies that are focusing on technology and insurance are taking traditionally higher risk populations where insurance premiums are very expensive, and they're using technologies like artificial intelligence to quickly collect and analyze data to identify healthier members of that particular segment. So if a person over 60 who is trying to acquire life insurance can demonstrate that he or she is more fit and healthier than the, let's say, average 60-year-old out there, through agreeing with the Insurtech company or insurance company to share fitness scores on his or her smartwatch, consenting access to public health records, or sending a photo where artificial intelligence technology can help analyze his or her health and fitness, then this particular 60-year-old could be rewarded with a higher quality life insurance policy with lower premiums.
Okay, well, this all sounds pretty transformative, but this is a very highly regulated industry, right? So I think one of the key questions is, what role do the state insurance regulators see themselves playing in all this? Yev or Yuliya, any thoughts on that?
Thanks, Julian. I'm going to start if that's okay. So that's a great question, and you're absolutely right. Insurance is a highly regulated industry. And in the United States, it's regulated primarily by the state, which means that each state has its own complex insurance code and its own insurance regulator that enforces and monitors compliance with that code. Now, I will tell you that a lot of these insurance laws are absolutely ancient, enacted as far back as the 19th century. When you stop and think about it, it's crazy that they apply in the context of the modern way of selling insurance, as Paul and Rohith were just talking about. I mean, we're talking about a time when the most disruptive, innovative technology was probably the telephone. But nevertheless, the insurance regulators do expect that every single participant in the insurance market comply with these laws, and that includes both your local mom and pop shop down the street and the most innovative technology insurance startup that wants to use AI in underwriting insurance and bundle it with a wearable device. Everyone needs to comply with these laws.
So I completely agree. And at the same time, we've definitely seen that these new technologies and new ways of doing business are influencing the issues that state insurance regulators are really focusing on. So there's definitely been increased interest in, and quite frankly, calls for greater regulatory oversight with respect to things like use of data, data privacy, cybersecurity. So just one example, so for the past several years, state insurance regulators have been grappling with how to best regulate the use of AI and machine learning in the insurance supply chain. So we've seen a robust discussion around issues like data integrity, validation, concerns about black boxes, and just generally the best ways to ensure that the use of AI doesn't result in actions that are unfairly discriminatory. However, when we talk about a coordinated regulatory approach, progress has definitely been slow in this area, partly due to the complexity and fast-changing nature of the issues, but also because state insurance regulators are having to balance sufficient regulatory oversight over what's happening in the marketplace, while at the same time not stifling innovation. So that's something that's always in the back of their minds, but it's particularly difficult to keep that balance when products and technologies are evolving so quickly. The main coordinated effort that we've seen so far is that in August 2020, the National Association of Insurance Commissioners adopted its principles of artificial intelligence. Those principles were really meant to provide a uniform approach to guide state insurance regulators in dealing with insurance-specific AI applications. But what we've seen is that the application of those principles is still very much a state-by-state view and very state-by-state.
So one way or another, and on various fronts, everybody's having to deal with these new and interesting consumer-facing platforms coming into the market. I kind of want to ask now a little bit about how they're getting to the market. How are they being developed, and what's behind that?
I can answer that. What we're seeing is a little bit more complicated dynamic in bringing consumer-facing platforms to the market in the insurance industry, because unlike consumer products that are sold, let's say, on Amazon, as you just heard, the insurance regulatory considerations are heightened and really core to how you can bring a product to the market or communicate with consumers. And so there's been a very complex dynamic among the players in the insurance industry, from the insurance companies themselves that have legacy systems and force of inertia on the way they do things, together with Insurtechs developing these new technologies and borrowing from consumer platforms on ways to reach out to folks. And of course, then the insurance regulator that is protecting the consumer. And so many of these insurance companies have had to tread fairly carefully, but they still need to invest. And they see the progress that other consumer companies are making with consumers. And so many of these insurance companies are developing venture capital arms to invest in various early stage companies and Insurtechs. And these days are even acquiring Insurtech companies to help build a consumer-friendly interface that is usable on an insurance company's legacy systems while still complying with insurance regulatory laws. Corporate venturing enables an insurance company to stay on top of technology trends while the company continues to transition from an established agent distribution system and older IT system and processes. When this is done right, corporate venturing allows a company optionality to support various insurance technology innovation that is a strategic fit for the insurance company, while also being a sound financial investment.
Yeah, so I think that's right. We often see a commercial agreement accompanying the types of investments Paul is describing. So the Insurtech benefits from not just the financial investment, but from locking up a strategic customer for its platform or for its service. And the insurance company gets the benefit of not just access to some really innovative talent and people, but from an actual service or technology that they can implement and deploy. But I think in general, when you talk about how these new customer-facing technologies are developed and brought to market, there's obviously quite a range of ways this gets done. There are insurance companies that are developing things entirely in-house. There are Insurtechs that are really focused on a B2B model and are building solutions that they can then license to insurance companies as a service. And then there are Insurtechs that are not B2B, that are B2C. They're customer-facing. They build the customer-facing platform. They source the customers, and then they partner with insurers who underwrite the actual policies. And actually, beyond just Insurtechs, there's big tech. Companies that are not insurers, they're not Insurtechs. That are interested in jointly developing new products with insurance companies. We've been working on more and more of these types of strategic transactions, lately. But the tech company in this scenario brings their treasure trove of data that they've collected about consumers. They bring their AI capabilities, and the insurance company brings its data, its underwriting expertise, and together you can really, build transformative, innovative products.
Okay, so and for these types of transactions, Paul and Rohith, you've just told us about these types of agreements that companies are entering into. What are some of the issues that the companies involved should be thinking about?
Yeah, from an investment side and business perspective, when you're looking at building a consumer platform and a collaboration type of network with another party, one of the top considerations is whether technology is actually proprietary and is comprised of processes that cannot be easily duplicated by another technology company. Since Insurtech has heavily borrowed from consumer applications, such as fintech, for example, it is important to verify that the technology is unique and is not just a package of older technology processes that are being applied to insurance. As previously mentioned, feasibility of technology is also highly dependent on compliance with insurance regulations. So a big part of looking into whether investment is going to be successful is whether it actually works from an insurance regulatory perspective, because we have seen time and time again a very, very cool technology that works in consumer applications or in other industries, but the insurance regulatory limitations make it much more difficult to use in insurance context. Another similar issue is confirming that the technology or consumer platform is actually compatible with insurance companies' legacy systems and processes, which have existed for a long time and have been built for another era. This includes ensuring that the Insurtech's intellectual property does not infringe on other third-party rights, and that the adoption of the Insurtech's processes into insurance companies' legacy systems don't create a cybersecurity threat or other type of cybersecurity issue. And finally, like most tech startups, Insurtechs really is a people business. It is critically important to spend time on any deal, whether it's investment or collaboration, to ensure that the people who have developed and understand the technology and its potential applications will have the right incentives to want to continue to grow the enterprise post-investment, acquisition, or collaboration. And this means designing the right option plans and other incentive packages. even if the insurance company's culture does not favor these types of incentives, so that the insurance company and the project can retain and attract talent.
Yeah, and I think, just to add to that, and especially, in my world and where I work with mainly, parties that are working on collaboration type agreements or licensing type agreements, there are a lot of different types of agreements that we see, from pure software licenses and SaaS agreements in a B2B context to much more bespoke agreements, particularly when we're talking about joint development agreements. And we probably don't have time to get into all the issues across the whole range of agreements, but there is some overlap, I think, on key issues. First, you need to determine who is hosting and operating the product or the service. If it's a straight software license where an Insurtech develops a software and provides it for an insurance company to operate on its own, the key issues there around, ensuring that your license rights are appropriately scoped, that the software is updated and maintained over time, et cetera. However, if it's any other type of collaboration where one party is hosting and operating a platform or product to the other side, that's customer facing, then there are a number of issues that pop up. What are the cybersecurity, privacy, incident response requirements? One party is storing, processing customer data on behalf of the other, so we need to address allocations of responsibility and liability. Two, how is disaster recovery and business continuity being addressed? Obviously, there's a dependence on one party's environment, so downtime is going to affect both parties. Three, what are the rights of each party to the data that's being collected and the data that's being generated? Each side may have interest in data, especially when you're talking about collaborations between insurers and big tech. They may have interest in data that diverge, so it's important to be clear up front about what's permitted and what's not. Four, how are changes and updates to the platform going to be handled? Who has a say over that? Who has ultimate control? And is it different when it's a change that's required to comply with laws? Five, how is the relationship with the customer going to be handled? How are customer complaints going to be routed? Who is the first line of support, et cetera? And then finally, six, how are we going to handle the end of the agreement? How are the parties going to disengage? Who gets to take what with them, and so on? These are all issues that cross all types of these collaboration agreements, whether it's between insurtechs, insurance companies, big tech, or otherwise.
Okay, yes, and as we mentioned before, the product at the heart of this is highly regulated. So obviously there's going to be regulatory concerns in any of these types of agreements. Yeah, Yuliya, what should companies be looking for on the regulatory front?
Julian, I think you hit the nail on the head. The key takeaway here probably is that insurance is a very highly regulated industry. So regardless of your company's role in a specific transaction, you really do want to be mindful of how insurance regulatory requirements impact and are ultimately incorporated into these agreements, particularly areas of growing regulatory risk like confidentiality, data privacy, and cybersecurity, which we've sort of mentioned before. But I think it's also important to take these insurance regulatory requirements into account even before putting pen to paper. So at the conception, program structuring stage, because there are certain rules that may not be intuitive to people who haven't operated in the US insurance market before, and wanted to highlight particularly the US market because we do see companies that are very successful abroad, but they want to bring their products to the US. So just as one example, one of the key prohibitions in the US insurance regulation system is the prohibition against rebates. These so-called anti-rebating or anti-inducement laws generally prohibit the offering of anything of value that's not plainly described or expressed in the insurance policy. And from this general rule in practice, you see this prohibition become relevant in a wide variety of ways.
Thank you, Julia. And let me give our audience a specific example of what this could mean. Paul talked before about one example of how an insurtech might help customers to save on their life insurance premiums by having them share data from, let's say, a wearable device with a life insurance company, right? And if these customers are more fit than the average person of that age, then maybe they can get reduced premiums. So let's say we have this great idea and we sit down to implement it, but we realize that just not everyone wears or owns a smartwatch. Or maybe some people who own smartwatches have smartwatches that are just not compatible with our technology for whatever reason. And we decide, well, that's okay. What we're going to do is for each customer that signs up for life insurance with us, we're going to send the customer a free smartwatch. And that seems great in concept, right? Because it's beneficial for the customer gets something for free. It's beneficial for us because it can help us to standardize our data and maybe even have other ancillary benefits, right? Like we can put our logo on the smartwatch and it'll help our branding. In fact, when you offer the smartwatch for free, what you're doing is you're providing something valuable for free to consumers outside the insurance policy. And under the insurance laws in most states, that's considered an illegal rebate, and you cannot do that. I have personally found that this absolutely shocks people who are not familiar with the state insurance laws. They just cannot imagine how doing something that's beneficial both to the business and to the consumer can be illegal, but it is. So circling back, these are the kinds of insurance regulatory issues that can arise in structuring an innovative insurance program. And when you're drafting the legal agreements for the program or just thinking about it, it's critical to consider these issues.
All right. Well, certainly a lot for our listeners to think about with respect to these issues. Any ground we did not cover? Any closing thoughts here?
Maybe just one closing thought to also follow on from what Yev is saying, because despite a lot of Insurtech investment and considerations over insurance regulations and how they can benefit the consumer while at the same time protect the consumer, I think we're still at the really early stages of the insurance industry adopting technology to improve customer experience and make the overall insurance underwriting and claims process more efficient and frankly fair. I think this creates a lot of opportunities for not just insurance companies and insurtech startups that are clearly targeted towards the insurance industry, but also technology companies and consumer companies that may not have originally thought about targeting their services and products to the insurance industry.
Well, thank you, Paul, and thanks, Yuliya, Yev, and Rohith, all of you, for your insights today. Listeners, if you have any questions about today's episode or an idea for an episode you'd like to hear about anything related to technology transactions and the law, please email us at techtransactions@mayorbrown.com. Thanks for listening.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.